There are four main topics we're going to cover in this program. First, we'll look at the different types of business ownership. We'll describe what they are and talk about the advantages of each type. Second, we'll see how to actually set up the business. That includes a look at the types of legal decisions you will need to make. Third, we will explore some basic marketing issues and get you started on selling your services and products. And finally, we will offer some marketing ideas that will help you make your business a success. The law lets you choose many different ways to set up your business. Some forms of business ownership are made to be easy. Some are made to allow flexibility. Others are made to conserve cash. A business can be owned by one person or by an entire group. Business ownership may be simple or it may be complex. The laws regarding business ownership vary from state to state, even from city to city. The information given here is only an overview. You should consult an attorney or legal advisor familiar with the law in your area before taking any action. The way you choose to set up your business will affect your day-to-day operations. Let's look at the four major ways that businesses can be set up today. The sole proprietorship is the simplest form of business ownership. Many sole proprietors do business under their own names. Technically, you don't even need a separate bank account, although it's a good idea to get one. A sole proprietor is a single individual who owns a business. Any money the business makes is the proprietor's money. Let's see some examples of a sole proprietorship. Mike Jones is a landscaper. He has a truck and lawnmower. He does business under the name Mike Jones Landscaping. His customers pay him by check made out to Mike Jones Landscaping, which Mike deposits into his personal checking account. Mike is an example of a sole proprietor. Now another sole proprietor in town is Peggy Smith Landscaping. Peggy has a problem. Because Jones comes before Smith in the telephone book, Peggy feels that Mike gets called first on his Yellow Pages ad, so Mike is getting more new business than Peggy. Peggy learns that she can register a trade name. If she chooses a name that is alphabetically before Mike Jones, that will get her listed ahead of Mike in the Yellow Pages. Peggy decides to call herself A1 Landscaping. She goes to the county clerk's office and registers the trade name A1 Landscaping. In most towns, you don't need an attorney to create a business name. You fill out a simple form called a registration of trade name, which you then have notarized, you pay a small fee, and you're in business. A1 Landscaping is now an individual legal entity. It can buy merchandise, pay taxes, and get sued. And because it's a sole proprietorship, the owner is liable for everything. Most sole proprietors use their Social Security number as a tax ID for their business, but Peggy decides to get a unique tax ID number. On the IRS website, she downloads Form SS4, Application for an Employer Identification Number. She fills out the form and calls the IRS Service Center. The IRS assigns her a new tax ID number right over the phone. Peggy is still a sole proprietor, but she has a new business name and a unique tax ID number. Now she needs to open a new bank account so she doesn't mix up her personal funds with the business funds. How do Mike and Peggy get paid? They simply write themselves checks for as much as they want. This is called taking a draw. Unlike the employees of a larger company, they have no money taken out of their paychecks for income tax, Social Security, or any other deductions. However, they have to pay estimated taxes to the IRS. This means that every 3 months, they need to send a check to the IRS for 1/4 of the amount of taxes they need to pay for the year. When they file their tax return, they will need to fill out a Schedule C, which will list their business income, expenses, and profit and loss. The Schedule C income is carried to their personal tax return. Unlike employees, Mike and Peggy have nothing taken out of their salaries for unemployment insurance. Unlike employees, if Mike and Peggy don't have any work, they won't get paid and they won't collect unemployment insurance. Unlike employees, Mike and Peggy have to pay out of their pockets for life insurance, health insurance, and disability insurance premiums. And unlike employees, the cost of those insurance plans come out of taxable income. In other words, a sole proprietor pays income tax on his life and health insurance premiums. Disability insurance premiums may or may not be taxable, depending upon how the policy is set up. To review the characteristics of a sole proprietorship, there is only one owner. It's very simple to set up. You can do business under a trade name. You receive money by taking a draw from the company. There are no unemployment benefits. Sole proprietors pay quarterly estimated taxes. There are no tax benefits for health, life, or disability insurance premiums. Your income is reported on your personal tax return through Schedule C. And finally, the sole proprietor is completely and personally liable for all debts, taxes, and actions. One day, Mike and Peggy get tired of competing with each other. They figure they should join forces and they'll have extra money to invest in new landscaping equipment. Mike and Peggy decide to form the next type of business we'll discuss, the partnership. Partnerships have gotten a bad name because they're often improperly started. Forming a partnership is like getting married. The two parties have to learn to respect each other's differing opinion. They have to learn to get along when the excitement of forming a new venture is ended, and they have to be able to grow both socially and financially. They will not agree on everything, although they have to support each other or their business is doomed. Many states require a formal written partnership agreement. Although you may be able to write this agreement yourself, it's a good idea to consult an attorney who is experienced in forming partnerships. There are many problems that come up in business relationships. An experienced attorney can help you recognize those stumbling blocks before they happen and can help you plan ways of dealing with them. Mike and Peggy decide to take the smart route and they contact a local business attorney. The attorney drafts up a partnership agreement that Mike and Peggy both approve of and sign. Their partnership agreement states how much and what kind of property each partner contributes to the new business. It sets a value for that contributed property. It describes when and how profits will be withdrawn. It states how the partners will be compensated for their services to the business. It tells how the partners will be compensated for their original investment in the partnership. And finally, it describes how changes in ownership will be handled, including what happens if a partner dies. Mike and Peggy structure their partnership so they are both 50% owners with an equal investment in the business. But Mike and Peggy have different personal goals. Mike's goal is to earn money. Peggy wants more free time. Mike plans to work 40 hours a week, while Peggy will only work 20 hours. They decide to pay Mike $1,000 a week and Peggy $500. So in salaries, Mike earns $52,000 a year and Peggy earns $26,000. At the end of the year, they calculate that the business will have $40,000 profit in the bank after paying their salaries. Since they're equal owners, they'll split that $40,000 profit equally, taking $20,000 each. So even though they're equal partners, Mike will make $72,000 a year and Peggy will make $46,000 a year. Just remember, Mike has worked 40 hours per week, while Peggy has only worked half as much. The partnership is handled much like a sole proprietorship for income tax purposes. The income from the business is carried over to the individual partner's personal income tax using a Schedule E form. The partners do not pay into or collect from unemployment insurance. And there are no tax benefits for life, medical, or disability insurance premiums. One extra concern in a partnership is that both partners are liable for debt, taxes, and legal action. For example, if Mike took out a $30,000 business loan for equipment, but then left town with the money, his partner Peggy would be responsible to pay it back. That responsibility for a partner's actions is a major reason that simple partnerships are not used very often. A more common form of business ownership is the corporation.